Hello and welcome. My name is Evan Branken and this is Adulting 101. Today we're joined by financial planner Bernie Mack, who's a parishioner here at our church and helps manage the Our Lady of Victory Investment Foundation. He's going to share some tips on investing for young adults. Bernie, take it away.
Hi there, my name is Bernie Mack and I'm a financial advisor, and in this video I'm going to be talking to you about building some wealth over time and achieving the ultimate goal of becoming financially independent. There are three basic steps. First is understanding the difference between your salary and your take-home pay. The second concept is to pay yourself first. And then finally, understanding and internalizing the magic and power of compound interest. And that's where I want to get started with, the power of compound interest. Albert Einstein calls it the eighth wonder of the world. He says, those that understand it, earn it, and those that don't understand it, pay it. So to better understand the power of compound interest, I'm going to use a tool or a concept called the rule of 72. So what you do is you take the interest that you're earning on your money, you divide that into the number 72, and that tells us how many years it takes for the money to double. So at 4%, it takes 18 years. At 6%, 12 years. At 8%, money will double every 9 years. At 10%, money will double every 7.2 years. And at a 12% rate of return every 6 years. So let's use an example. So you could say, well, if they stuck it in at 4%, your $10,000 would have doubled twice. So on your 36th birthday, you're handed a check for $40,000. You grab a can of Bud Light and toast your great aunt or your great uncle. They got very aggressive and perhaps a little bit lucky with their investment over the 36 years and earned 12% a year. The money doubled 6 times. In that 6th doubling period, we're doubling the 320, and now we have $640,000. Certainly you wouldn't be toasting with Bud Light probably, but maybe perhaps a glass of champagne. And there's also different strategies that you can control that will help you earn 2% better rate of return. So as an example, if we're earning 10% on our money, but we have to pay taxes on that 10%, our after-tax return might be 7%. Well, if you sign up for your company's 401k plan and put money in before taxes, the full $10 gets put into the 401k plan. So it costs you $7 to save $10. So you've just earned a 3% better rate of return. So that's a great way of getting started. Sheltering money from being taxed is a great way to increase your rate of return over time. Most employers today will also do a company match on your contribution. So if they match 50 cents on the dollar as an example, so now you have $15 going into your 401k plan, and your net cost of having that $15 saved was $7. Don't leave money on the table. Start paying yourself first. They're talking about two options, traditional 401k contribution, or there's this thing called the Roth 401k. So with the traditional side, it grows tax deferred, and then you pay tax on the back end when the money comes back out. With the Roth contribution, the money goes in after tax, so that down the road, when you start to take the money out, there's no taxes at all. And so you may want to look at which is better for me. Part of it's going to depend upon your income and your tax bracket. Getting started off, chances are you're going to be at the lowest earnings point in your life. And as your life progresses, you're going to get pay raises and job advancements. For most young people, putting into the Roth contributions initially would be the best way to go. So the question is, would you rather pay tax on the seed and not pay tax on the harvest? But remember, the company's contribution is going to be the before tax contribution already. That's already money that will be taxed down the road when it comes out. So you're going to have that anyway. What are the main drivers when it comes to performance in our portfolio over time? The largest driver is actually us, and it's our behavior on how we respond to different things in our investment portfolio. So we call this behavioral finance. They measured the performance of investors' portfolios versus the stock market as a whole. The stock market grew by an average rate of return of 10.5%. The average investor earned less than 2.5%. Same time frame, much, much lower performance. And the attributing factor to that can be understood through behavioral finance. The two main emotions that are involved with investing is fear and greed. Greed is, geez, the market's going up, I got to get in on this and I don't want to miss out. So we start investing more and more when the market looks like it's going up and up and up. Fear is when the market starts to go down. Now we have the fear of we're losing what we've worked so hard to accumulate, and we don't want to lose any more. So we try to cut our losses. So fear and greed drives us to do the exact opposite of what we should be doing. Warren Buffett said, be greedy when everybody's fearful, be fearful when everybody's greedy. And know thyself, know your own investment emotions, and whether those are helping or hurting in the investment decisions you're making. Don't ever make a quick investment decision. Always think about it before you make a trade. One example of behavioral finance is the concept of overconfidence. When it comes to investment, the way that manifests itself is when we buy a stock and it goes up, we pat ourselves on the back. We take credit. But when we buy a stock that loses money, goes down, we blame it on bad luck. Be honest with who you are as an investor. You're just getting started. You don't have an investment portfolio yet. So you want to be really aggressive. Now that doesn't mean being stupid. You don't want to be investing in low risk investments. You want to invest in the stock market. And then you want to hope the stock market crashes. Why? Because you're just now starting out. You don't have any money in there yet. And now you're buying. And you're buying at these lower and lower prices. So each month the market continues to go down. The number of shares your monthly contribution is buying goes up. So you want to look at the investment options that are in the 401k, that are in the stock market. Many of them are what are called target date funds, which means they target a certain year. So the shorter the year 2020 is going to be the lowest risk option. The 2060 is going to be the most aggressive option. There's individual mutual funds perhaps that are in there as well. And these can be growth companies versus value companies. A growth company is one that doesn't pay us a dividend, because they take all their earnings and they reinvest it back into their own business to try to grow their business. Value stocks are companies that have been around for a while, and when they're profitable, they pay us a dividend. Typically, those can weather recessions better. I think it's good to have both in your portfolio. You can pick stocks based upon whether it's a large company or a small company. Again, large companies will hold up better during economic recessions. Over time, small cap stocks outperform large cap, or have at least historically. So when we say large cap, we're really saying large capitalization or small capitalization. So capitalization is the value of the company, how big the company's valuation is based upon the number of shares they have outstanding and the price of their stock. So the large cap stocks are your largest companies. And then you can also decide, do you want to just invest in the US or do you want to invest overseas? So you can have international stocks as well as US stocks. But that's also a behavioral concept where we tend to invest based upon a home bias. So if we live in the US, we'll invest in US companies. If we live in the Quad Cities, we'll own Deere stock. Diversify between large cap, small cap, US, international, growth, and value. If you don't want to do all that, the target date funds will do that for you. Don't be afraid to ask questions. Your parents are a great source. Ask your employer, ask fellow employees. There's lots of great books out there. The Intelligent Investor wouldn't take you that long to read, but it gives you some great insight and understanding. And there's a difference between trading and investing. Traders are the ones that you see on TV and hear on the radio that are in and out, maybe multiple times during the day. Investors are just people that are looking to own good quality companies over time and let the market do its magic. And that's all I have for today's discussion. Hope you learned something from it, and good luck with adulting.
Thanks for watching. This has been another video in our Adulting 101 series. If you enjoyed it, please hit like, subscribe, click the bell so you're notified when we release new content. We'll be doing more videos in this series on a variety of topics, but if there's something you really want to hear about, feel free to let us know and we'll try and make a video just for you. Thanks, God bless, and have a great one.